Greetings. Keith Prather here with the NCM Farm Equipment Economic Update. Let me go ahead and share my screen. Boy, has it been a month. There's been a lot going on. Uh, so the Farm Equipment Demand Index that we'll start with here, we're seeing a little bit of a flattening out. So, we've had a longer term decline. It started in 2022. It's been in a virtual decline all the time up until about late last year. I guess December of last year is when it kind of started to turn. And we saw it flattening out a little bit. You can see some of the data over here. See the scores are right at a 59.4. Still growing pretty good. I think overall, one of the most important facts to look at is that we're still significantly higher than we were prior to the pandemic. The problem is that many equipment dealers, a lot of manufacturers have reset their cost structure. So the number of people working, just the wages that they're paying, those things based on a higher demand index and a higher demand and higher volume of sales. So it feels contractionary or recessionary to them right now because things are so flat compared to the last couple of years. Again, historically, we would have enjoyed this kind of level of growth. Still below the long-term trend line, which we're watching, but we're hoping that there are signs of a turn, and we'll talk about that in just a moment. Let me get my screen. There we go. So the industrial production index, which is a little bit different, we look at what's actually being built right now. We did see it soften. It's because inventories are fairly high. A lot of dealers are probably pushing back a little bit on brand new wholesale orders, kind of telling OEMs, hey, I'm overloaded. You got to hold off for a little bit. And that's kind of what we're seeing. It was 7.6% lower month over month through February, through the end of February, about 13% lower year over year. Um, some of that could have just easily been everything from weather related impacts to the Chinese Lunar New Year. But we're not seeing the same kind of response that we're getting in some of the other sectors that we look at for NCM, like power sports, marine, automotive, where clients are kind of getting out ahead of tariff risk. We don't necessarily see that so much in the farming community. So industrial production is still pretty low. OEMs are not really building that inventory. But there's a couple things to watch that I think are really going to be fascinating for the industry as we look forward over the next half a year. So we talked about this last time, but I think it's worth reiterating that the first $10 billion in bailout funds, and these largely stem from losses that the farming industry took in 2023 and 2024, that 35.7 billion has been appropriated, but only the first 10 billion has hit the market. So if you experienced a little bit of an uptick in foot traffic, a little more interest, maybe some farmers coming out, starting to shop a little bit, starting to get an idea, having coffee, having discussions, whatever you want to call it. That first 10 billion is just now hitting the market. And again, the average farm is going to see somewhere between 125 and $250,000. A lot of them will have to use that to pay down existing debt. But we believe, based on estimates, that again, there's still $2 to $3 billion that will be left over for equipment purchases. We also, in the power sports sector, talk a little bit about side by sides, and a lot of farmers that did keep their debt under control were able to make payments. And getting these bailout funds are going to have a lot of extra cash to be able to go out and do some interesting things with. So that's going to be something to watch, and I think that will create a little bit of juice for the industry. It won't be significant overall, but it's gonna help out a little bit. The other thing we're not exactly sure about is what the national meat supply is going to look like and what that does to ranch incomes. By that, what we mean is national herd size right now is down to their lowest level since 1951. And if you look at the number of breeder cattle that are being added to the national herd size right now, it's not large enough to be able to sustain or to be able to grow the national herd. So you think about the annual consumption and what we get on consumption. If those levels stay at current rates, we're not replenishing the national herd fast enough, and that's what's keeping meat prices higher. The other piece of this is that we've had some illness down in Mexico. There's been some viruses they've been watching pretty carefully, and they had stopped imports of meat from Mexico specifically for quite a while, and that has slowed down obviously some of the national market. But with meat prices higher, that should give a lot of ranchers in a lot of markets, not all markets, but in a lot of markets, a little bit of headroom. even though current drought maps look like the Texas and Oklahoma area are getting hit hard, they've actually had a little bit of relief of late, and it's a little easier for them to feed. Feed costs are down a little bit. Up in the northern regions, the northern plains, a little different story. So we're seeing herd sizes trimmed a little bit, like in the Dakotas and down into Nebraska and Kansas, maybe a little bit larger herd sizes growing kind of in the Texas markets and up into Oklahoma. But again, we'll look and see if those ranch incomes go up. Expect to start seeing some, some of those folks coming out, especially the ones who are doing multiple income, farming and ranching. Watch for them to, maybe to be out shopping for new equipment. So tariff discussions. I mean, I know that's the big topic that everyone's talking about. And at the time we were recording this, it was prior to April 2nd. So we don't exactly know what the final orders will be from the Trump White House, but we do know a couple things. So for the farm equipment industry specifically, what I'm watching is reciprocal tariffs. And by that, what we mean is that, countries charge the US tariffs on products. We also charge them tariffs on products. There's a differential between the US and many countries. Many countries over the years have boosted their tariffs on US goods high enough that it's prevented a lot of US products from being exported to those countries. What the Trump administration is doing is just simply saying, if you charge me a 13% tariff and I charge you a 3% tariff, we're going to equal those out, or you need to bring yours down. And what we're finding is what's interesting is maybe in the ag industry, it's going to work like a catalyst for growth. An example that I have on this particular page is China right now imposes a 16% tariff on all US ag commodities, but the US only has a 3.3% tariff on Chinese products. So just assuming that the reciprocal tariff issue kind of hits just that market, right now China probably cannot absorb a 13% increase in US tariffs on Chinese products, especially those ag commodities, those ag products that we do get from them. It's not a lot, it's not a big volume, but there is a chance that China would prefer to lower their tariffs to the 3.3% rate or find an equilibrium, meeting in the middle somewhere. But it should create a little more market opportunity in those markets. And China was probably a bad example. That's the one that popped up to the highest when we look at the trade differential, that difference, and that's the one that would have the biggest impact. But Canada, Japan, the EU, there are other countries where we have that differential, and we'll be closing that gap. And we think that many countries will opt to lower their tariffs rather than accept the US reciprocal tariff. So that could open up markets, which should push commodity prices, we think, a little bit higher for US commodities. Um, it's going to be sluggish because global demand right now for products is down. Um, but there's a lot of things moving right now. Like we know that the Ukraine negotiations to end the war are not going really well. We know that right now the Trump administration is trying to really clamp down on Russia using brand new sanctions, trying to tighten it further. But Russia also is making some advances in an area known as Odessa, which is the primary export point for a lot of Ukrainian grain. And so with Russia and Ukraine combined controlling about 32% of the world's grain exports, this could become a factor, could be something that we see be a big problem in the near future. So we'll see what happens overall. I mean, like I said, a lot of moving parts, and we're not exactly sure how this all plays out. But what's interesting is we're just getting brand new data out of March, but the overall farmer sentiment has improved over the last 2 months. Even though it was a little rocky road, where the farmers were concerned about reciprocal tariffs or retaliatory tariffs from foreign countries really kind of hitting U.S. Commodities like we saw back in the 2018-2019 period. We saw sentiment bounce in February jump up to almost 60 points, which, we've got to go, other than just coming out of the lockdown period, we're getting back into levels that we saw, prior to the pandemic, 2019 or so. So we were pretty optimistic there. We saw just the latest reading that just came out today of 54 points, still elevated, still high, but this is the Farm Capital Investment Index. So this is what they plan to spend. Farmer sentiment was still doing pretty well overall. And as soon as they start to get some word of what's happening with reciprocal tariffs, and maybe that it opens up foreign markets rather than clamps them down, I think you'll see this improve, and I think you'll see the capital investment expenditures, and you'll see the optimism about expenditures rise. The other thing that would happen is that we've already got, as I said, the first $10 billion of the bailout funds that have been issued, but there's another 21 billion behind it. And as they start distributing that 21 billion, that's also going to help boost capital investment summaries. But I think farmers are, they're not all from Missouri, but they all want to see that money hit their banks. They want to see that it's real, and they want to see that they're getting it before they decide what to do with it. So I think that this will improve a little bit over time. Now, I could be wrong, but it just looks like things are aligning in a way that should start to help the farm economy. Maybe we start to get a little more optimism, hopefully more than we've had over the last couple of years. So last slide I had for you this month is just our index for machinery, and this is the machinery production side of things. And even though it's flat through probably May, we are sensing right now in the data a mid-year increase. And so you see that we should see some improvement in both equipment demand and equipment production between now and the end of the year. Now, a lot of this is going to be transportation type equipment and machinery, but some of it's going to be ag related and ag equipment machinery purchases. So um, we're hoping that this all means that the second half of 2025 looks like a better year. We know that sentiment right now is kind of all over the place just because of the tariff risk, and nobody knows what to do with it. But again, as we've kind of talked about this month, and we'll be able to reiterate it more next month as we get a lot of details on what's happening specifically with the tariffs. And we think overall it could be a little bit better year, but we're gonna wait until we see how the dust settles. So, okay, hope that was useful. Looking forward to seeing you next month. All right, take care.